What if I told you that one of the best performing investors alive, often called Australia's Warren Buffett, just made 8 major bets you've probably never heard about? That's Kerr Neilson. And while most investors chase AI hype, he's buying companies that are quietly positioned for massive upside, even in a shaky 2025 market. From undervalued industrials to global tech plays, we're breaking down 8 high upside stock picks he's making right now. And the last one, it's trading at a massive discount with double-digit revenue growth. Let's get into it. Starting us off is PTC Inc., ticker PTC. With roughly $1.5 million allocated, this software company makes up a small slice of Neilson's portfolio, but don't let that fool you. PTC is a hidden powerhouse in industrial software, offering platforms like Windchill, Onshape, and ThingWorx. These tools enable real-time collaboration and smarter product development, especially for companies undergoing digital transformation. Why is this important? Well, we're entering a world where cloud-based infrastructure isn't a luxury, it's a necessity. PTC recently partnered with Nimble, a robotics firm, to replace its old systems with PTC's cloud platforms. And that's no small feat. They did it in just 60 days. Talk about efficiency. Even better, PTC is putting its money where its mouth is, repurchasing nearly 500,000 shares and paying off $500 million in senior notes. Financially strong, growth-ready, and favored by analysts. But here's a question. Could a niche software provider like PTC be the next breakout star of the digital industrial era? Coming in next, we have Flutter Entertainment. Traded under ticker FLUT, Neilson holds over $8 million in this global gambling and gaming giant. With brands like FanDuel, PokerStars, and Betfair under its belt, Flutter is a household name in the betting world, and it's expanding fast. Recent acquisitions in Brazil and Italy have supercharged its market share, with $220 million in projected new revenues. The Italian market alone could now see Flutter holding nearly 30% of the pie. Even with a rocky March Madness, the company's sportsbook revenue jumped 15%, and iGaming rose 32%. Impressive, right? So why does this matter? Well, Flutter isn't just surviving the global gaming shakeup, it's thriving. For investors, the global reach and consistent earnings make this a potentially rewarding play. But here's something to think about. With rising regulations, can Flutter maintain this winning streak long-term? Next, we've got Synopsis, ticker SNPS. Neilson has about $1.4 million in this high-tech software company, and for good reason. Synopsis builds the tools behind chip design, software that powers everything from AI to self-driving cars. What's more, a major policy shift just happened. In July, the US lifted restrictions on exports to China, and Synopsis stock jumped nearly 8% overnight. That's a big deal. China only made up 10% of Synopsis revenue before, so just imagine the growth potential now. The company might also be acquiring Ansys, another giant in engineering simulation software, giving Synopsis even more dominance in the EDA space. Analysts are bullish, and it's easy to see why. Still, there's a flip side: geopolitical risks and dependency on advanced semiconductor development. But here's a question. Could Synopsis quietly be one of the most important players in the AI supply chain? Let's move on to a more familiar name: CVS Health, ticker CVS. Neilson's stake here is smaller, but strategic. Healthcare remains one of the most resilient sectors, and CVS offers a unique blend of pharmacy, insurance, and wellness services. Despite headwinds in the broader healthcare industry, CVS pulled in a whopping $95 billion in the first quarter revenue, up 7% year over year. Their earnings? Solid. EPS landed at $2.25, with full-year projections still holding steady. Plus, with nearly 10,000 retail locations, CVS is well-positioned to serve an aging population and capitalize on growing demand for accessible healthcare. But ask yourself, is CVS undervalued right now compared to its long-term potential? Now let's talk about comfort stocks. General Mills, ticker GIS. This company, known for brands like Cheerios, Haagen-Dazs, and Blue Buffalo, is a staple, literally and financially. Neilson's holding here is modest but strategic. Although recent guidance hinted at a 10–15% EPS decline and organic sales slipped 3%, the long-term brand strength remains undeniable. Consumers trust General Mills, and in uncertain times, that trust often translates into stable returns. So what's the risk? Slowing growth and shifting consumer habits. But here's a question for the long-term investor. Is stability more valuable than high-growth volatility in times of uncertainty? Up next, we have a heavyweight, Micron Technology, ticker MU. Neilson has placed over $81 million in this memory chip maker, making it one of his biggest bets. Why? Because Micron is at the heart of the AI hardware revolution. Its DRAM and high-bandwidth memory chips are critical for powering next-gen AI models. In fact, its HBM market share could reach 25% by year's end. And the upcoming HBM4 technology is expected to generate over $17 billion in revenue by 2026. That's huge. Add in a 46% YTD stock gain, and it's clear. Micron's not just riding the AI wave, it's helping build it. Still, semiconductors are cyclical. Prices fluctuate, and competition is intense. But ask yourself, how many companies are this well-positioned for both AI and global data expansion? Coming in at number 2 is TransUnion, ticker TRU. With over $142 million invested, this credit reporting and analytics company represents over 8% of Neilson's portfolio. TransUnion has benefited from a friendlier macro environment lately, lower inflation, stable jobs, and fewer delinquencies. And that's key, because TransUnion services are deeply integrated into the financial system. From credit scores to fraud detection to marketing analytics, this company plays a crucial role in industries like insurance, banking, and even telecom. But can it keep growing as interest rates fluctuate? That's the question. Still, when a billionaire allocates this much to one stock, it's worth a closer look. And finally, at the top of the list, Adobe Inc., ticker ADBE. With just over $1 million invested, Adobe may not be Neilson's largest position, but it has the biggest upside potential, nearly 30% according to analysts. In the second quarter of 2025, Adobe delivered $5.87 billion in revenue and $2.19 billion in cash flow. Not too shabby. Its flagship platforms, Photoshop, Acrobat, and the new AI-powered Firefly, are dominating the creative space. The company is even ahead of schedule on its AI revenue goal for the year. However, competition is heating up. Figma, a design startup Adobe once tried to buy for $20 billion, is now preparing for an IPO. That raises concerns about Adobe's market share moving forward. But let's be real, Adobe is a behemoth in the creative economy. As long as content is king, Adobe has a throne. So here's the final question. Is this your chance to buy into a tech titan while others hesitate? These aren't just random picks. Each of these companies holds a unique position in the market, and the fundamentals really back that up. For instance, Synopsis and Adobe boast some of the highest gross margins in the group, at over 76% and 88% respectively, clear indicators of strong pricing power and efficient operations. On the other end, names like Flutter and CVS show lower gross margins, but they make up for it with wide-reaching revenue streams and scale. Adobe stands out not only with the highest EPS at $15.64, but also a massive $22 billion in revenue, clearly dominating in its niche. Meanwhile, TransUnion and PTC offer much smaller revenue footprints, yet their growth potential lies in specialized markets like credit analytics and industrial software. Micron and Synopsis are battling it out in the tech arena with high current prices and significant EPS, both showing strong relevance in the AI and semiconductor space. And while General Mills may not be as flashy, its earnings show that slow and steady consumer staples still have their place. To wrap it all up, Kerr Neilson's portfolio is a fascinating blend of software, healthcare, AI, consumer goods, and finance. It's not about chasing hype. It's about recognizing undervalued giants before the rest of the market catches on. Before you go, here's something to chew on. If a recession did hit tomorrow, which type of stocks would you trust to hold the line? And here are 7 undervalued tech stocks that could explode in 2025. Click on this video here.